Now are Omar Aguilar of Schwab Asset Management and Kevin Mahn. Mahn, right?
Mahn is
right. Of Hennion and Walsh Asset Management. Guys, good afternoon. Kevin, thanks for joining us here on set. I mean, you say that the long-awaited economic slowdown might be here. In a weird way, that kind of sounds like the food might have cooled off enough that you can really dig in and eat it. Is that where we are? We can eat without getting burned, or is there the risk that it's getting too cold?
There's absolutely the risk. And we have to remember that the 525 basis points in rate hikes from the Federal Reserve were intended to slow down consumer demand and slow the economy. We saw that happen in the first quarter with the revised GDP growth rate of 1.3%. Where does that go from here? So my concern right now is that the Fed keeps rates too high for too long and pushes that economic slowdown potentially into a recessionary period. But the Federal Reserve realizes that risk. That's why I believe there are at least two rate cuts still on the table in 2024.
At least. Okay. Well, Omar, the labor market is cooling. Working class spending especially cooling too. We're in a jobs report week. So what's the most important unanswered question that you're going to maybe get some data on in that report this week?
Well, I think, the expectation continues to be that we see that cooling down on jobs. I think the bigger question mark will be what happens with wages, as we already seen that, significant changes in wage growth could have an impact in consumption. And at the end, it is really that part of the consumer and consumption that affects the part of the GDP. And we already know that 60% of the low end of the consumers are already being squeezed. So wage growth will have a significant impact on what may be the next reads for the U.S. economic growth.
Kevin, I want to go back to this idea of two cuts at least this year. I mean, obviously, we're getting jobs data later this week. You got an FOM decision next week. We know they're not going to cut. It's really about the dot plot next week. In the meantime, the fact that we are starting to see softer data, signs of slowing economy, I mean, we could talk about a soft landing for the economy, but what does that mean in terms of a possible soft landing for stocks? Because if you see that disinflation narrative begin to pick up in a more meaningful way right now, how do stocks continue to trade at these levels, realize this earnings growth, even if they're starting to see less pricing hike ability and they're seeing softer sales?
It's a phenomenal question. And let's go back to the beginning of the year. The beginning of the year where some suggest that we might have 6, 7 interest rate cuts. And then I saw just last week some suggesting we might get an interest rate hike, or perhaps, as we saw in Barron's this past weekend, no rate cuts this year. You know who hasn't changed? The Federal Reserve. Their December dot plot chart, 3 rate cuts forecasted, 25 basis points each. Their March dot plot chart, 3 rate cuts of 25 basis points each. We'll get an update next week on that dot plot chart. But what if they stick with those median 3 rate cuts? That could potentially provide a tailwind for stocks, get some more money off the sidelines and prevent this economic slowdown from moving into a recessionary period. However, each meeting that goes by where they don't cut rates, I think there's the risk for more volatility that we haven't seen in the stock market thus far in 2024.
Omar, I realize we had a choppy trading session here today. We started higher, we went lower, we ended higher, at least well off the lows with the major averages, but it does cast into focus the same dynamic that we saw last week, which was this AI secular growth story was not enough last week to lift the broader markets. And you saw that tug of war here today, too, with all the news coming out of NVIDIA and AMD and the like. How much fuel is still in the tank around that trade?
Well, the big part of this continues to be that the earnings results that we have seen so far continues to suggest that there is a multiple expansion as well as an increased cycle on capital expenditures. And any companies that can continue to generate free cash flow and has attractive yields on free cash flow that also can demonstrate that their capex has a future earnings growth potential will continue to dominate the market. And I think what we're seeing a little bit today is more of this tug of war of what the economic news be on manufacturing. And I think what was described before of this idea of like like, are we going to go back to what we discussed about a potential recession? We discussed that for 2 years. Or is it really just that the inflation is finally resuming into the place where the Fed wanted to be, and we're going to see the path towards that 2% inflation that they have? So that macro component seems to be overlying all these trade-offs, whereas I think the micro component continues to point to stronger balance sheets, higher quality companies with good CapEx.